to see you for the third time today.
There you go. You're going to throw it on there. Okay. Yeah. So I had a couple of technical difficulties that, we'll just let that go. All right. So what we were talking about, we'll kick it back to the beginning. We'll let you kind of start it off because obviously we don't have the context of the other videos. But,
Yep.
you were talking to me about the question that got asked by one of your clients, and I think it's a good one. So go ahead. Let's start.
Yeah, I think it's a very good one. So a client was talking to me about, an offer that they're putting in, and they're all excited, and I'm all excited, and they say, so when can we expect to hear back? And, my gears immediately start turning as I'm going, well, obviously, 24, 48 hours. And then I realized as I was speaking, I don't know for sure.
Yeah.
So that's not really my side of the aisle. So I figure, let me hear it from the pro. So how does that work? You submit an offer. When do you hear back?
Well, there's two ways of looking at how you respond to an offer. So first and foremost, in a contract, okay, there's language in the contract that basically state, I don't remember the exact words, but basically it states, hey, look, and everything's going to be done as quickly as possible and reasonable. So when you put in a contract, when you put it across an offer, the expectation is that I've given something to the seller is going to return, 24, 40 hours, 36 hours, something like that. That's the general professional and courteous understanding between agents and their clients. That said, technically speaking, unless you put in the contract an acceptance date, that contract is open it's in perpetuity for all intents and purposes. Wow. Because you haven't put anything on it that stipulates that the contract has an end date until it is fully executed. Once a contract's fully executed, then the closing date becomes the date of the contract, with the contingencies for, say mortgage contingency and all that crap. But if you put across an offer, so I'll give you a real example. All right. So another agent that I work with came to me, called me up and said, I have an offer that I've put in on a contract. I need your advice. I said, all right, what's going on? She said, we put across the offer. We did not put an acceptance date on it. I said, so what's the problem? She goes, we put across the offer 6 months ago and they just sent it back executed. Okay. So I'll give you another example. We just put it, you remember there's a couple that you and I are working with. So showed them house on Tuesday. Now this is where you get into what is courteous, what is professional. All right. We put in an offer on Tuesday. Didn't hear back Tuesday night, even though I reached out to the agent for at least acknowledgement of and receipt of the offer. Didn't hear back Wednesday. And then Wednesday evening, I finally get a note saying, yep, we got the offer. Okay. I still don't have an answer on what's the seller's response to the offer. This morning, today's Thursday, this morning I get a call from her. And she says, yep, we're looking it over, but the seller has now decided they want to give it another day because there's some showings coming up and they want to see if they can get a better offer. Okay. Or I should say, she didn't use the word better. They want to consider other offers, which is basically saying, look, your offer is good, but it's not a slam dunk. Yeah. All right. Not every offer works for every seller. But the issue that we run into is we put the offer in on Tuesday night. We're not going to hear back until Friday. That's Wednesday, Thursday, Friday. That's 3 full days. That's not excessive, but it really is discomforting, especially when you're in a market where everybody's kind of scrambling, particularly for buyers. They're scrambling to get something done. So again, the first and foremost thing, there's no set time frame unless you specify a time frame. There's just a general understanding and a professional courtesy between everybody to say, look, you're going to get a response back. I'll give you another example. One of my investor buyers, we put in an offer. We went and looked at a multifamily for him on a Thursday. We went back Friday morning because we got a notice that they were going to be considering multiple offers. I talked to the listing agent. She said, yep, we're definitely taking him. I said, all right, he wants to see it one more time. So we went back on Friday morning. Wrote the offer up on a Friday. 2 Sundays later, they finally accepted an offer. 2 full weeks went by. Okay. And the whole time we're reaching out, of course, saying, hey, listen, you got to give us an answer. You got to give us an answer. And the whole time they're saying, yeah, but, oh, wait, then the negotiation starts for getting additional offers. Do you want to go up? Oh, we've decided we're going to extend the period. Because what's happening right now is because inventory is so tight, buyers are constrained to say, geez, if I take my offer off the table, what if I'm the winner? Right? And there's that winning mindset that we talk about. What if I'm the winner? Geez, I don't want to take my offer table. So then it gets to, well, what if I put in an acceptance date on the contract? And now you've gone past the acceptance date. You're out of the game. Yeah. So this is where it really comes down to agents have to communicate and work together and advise both parties to say, look, you got to make a decision on this quickly, which is why we tell buyers, get out there, do the showing, put in the offer. Because even though a seller may take more than the 2-day period, that's kind of an understanding. Even if they do that, your offer's still there and it's intact. And again, an offer stays intact until something is executed.
So that brought up I wrote down two things. The first of which is good but not great offers.
Right.
So when you submit an offer and you get a situation where somebody says, yeah, we got it. We're going to wait a couple days, see how the weekend goes. That's kind of a soft, your offer is good but not great acceptance, isn't it? Like that in and of itself is almost like a
you know that you don't have the winning
response,
right? So
right?
The problem with that, so I know you said you had two things. By the way, the conversation you and I were having just before we started this, he wants to write that up for 265. So we're going to change that. Okay. So the issue is when an offer is really, really good, you would think that it would be, if it's a slam dunk, you would think you'd get an immediate response. The problem is that sellers are being coached by agents to give it time. Because remember, Bill, what makes for a great offer is not necessarily the price. Terms of a contract can far outweigh a price if you have a seller that has the right understanding of what to look for in a contract. But a lot of sellers are coached, wait for the price, wait for the price, wait for the price. And then it's oh, look, we got it $30,000 over our listing price. That's fantastic. Well, but the terms of the contract could be crap. So this is where that particular client that we're talking about, they put in a good offer. It is a good price. It's above list price, but we know that the terms of their contract are soft because of the loan type that they have to use. So this is where it's a good offer because the price is there, but it's not a great offer because of the terms. So the seller in this case is going to wait to see if they get in a comparable price offer with better contract terms. And this is going to be always where the jockey of what makes good versus great comes into play. And I firmly believe that if you're representing a seller or a buyer for that matter, but if you're representing somebody, you should be looking at the contract terms, because what is going to create the greatest confidence for a transaction to be completed? Price is not the factor. It's the terms of the contract. And price, though, is what everybody hears because it's what we all talk about all the time.
Yeah.
What was the second thing?
Well, I want to piggyback on that just a little bit. Do you think because it is such a strong seller's market that there is some of the, let's say a seller, I list for 250, I'd be happy to get 250. The very first offer that comes in is 260. Does that mindset immediately switch to, well, if they're going to give me 260, I wonder what else is out there.
Yeah.
Almost like the gambling side of it.
Yeah, this is the coaching piece I'm referring to, in the coaching by a listing agent to a seller. Okay. Because what's happening, and when I go and I meet with a seller, I always bring to them, here's what the market says your property is worth based upon those comparable sales and based upon the different data sources that I referenced. Okay. So I go through and I detail all that out. And then I always tell them, here's the reality of it. You're going to get in offers that are going to be excessively more because market says right now that it's a seller's market and continues to be because of the lack of inventory. But just because you get in a high price doesn't mean that it's a great offer. I'll beat that whole dead horse again. But what we're seeing more and more are sellers have been sometimes directly or just indirectly at the very least coached to the idea of, hang on, let's see what else we get. The way I work with sellers is always to say, listen, you keep the listing live. You keep showings taking place until you get the offer that makes the most sense to you. This whole highest and best routine is going to come to an end at some point in time. But when a seller gets in an offer, they're not required to accept an offer. They're required simply to acknowledge the offer. And then it's the agent's responsibility to go back to the other agent, the buyer's agent, and say, we got your offer. Thank you so much. The seller's considering it. We will get you an answer by this time. Now, what the seller's risk is, if they say, you know what, it's not a great offer. I don't want to take it because I think I'm going to get a better one. Now the seller's gambling with whether or not they're going to get another offer that's going to beat or exceed it. And this is where sellers play the let's wait and see game. Yeah. Well, this is when you get into the calendar of the week issue. What if that offer came across Thursday night? I can guarantee you, unless it is crappy weather outside and it's going to be hailstorms and everything else, the seller's going to wait and see what the weekend does for showings.
Yep.
That's part of the hurdle that they have to come over. And again, not wrongly, but a seller is being coached. Let's wait and see, especially if it's the first offer. If it's the third or fourth offer, sellers should be in a position where they can make a decision by that time.
Yeah. Okay. So the other note I took, because I've used this word a lot lately, or this phrase a lot lately, and I feel like it was a big part of the whole experience, the whole transaction, and it seems like maybe the table is shifting so that it's not as balanced anymore. But good faith. So a lot of what you were describing, I kept hearing in my head, good faith. Like this is the seller acting in good faith, the buyer acting in good faith. I'm putting in an offer. So for instance, a buyer puts in an offer. They're making that offer in good faith, saying, I'm putting in this offer because I have an intent to purchase your property.
Right.
They don't put in 10 offers at once, which would be great for buyers, wouldn't it? For a buyer to just go, I'm going to go look at 10 properties. I'm going to put in 10 offers.
Yeah,
I'll maybe get 5 accepted, and then I'll choose which one I want to go for.
Actually, okay, so hang on a second. So it's less a legal issue, but more of an ethics issue if a buyer and their agent are doing that. Okay. I'm not going to deny the fact that on more than one occasion, I have had a buyer come up to me and say, George, we want to put in offers on multiple properties at the same time, just in case. And I always pause and say, be careful, because we're creating a lot of risk if we do that. And I've been able to coach each time. I've been able to coach them away from that to the point where we say, okay, we're going to write up these offers and we'll have them ready to go, but we're going to drop this one now because we should hear back by this time frame with that agent. And then if that's not good, then we're going to drop the next one in. So we can write up offers in advance and then time the submission of the offer because we're getting answers back. But this way, at least all the paperwork's done. But if you have somebody who is actively going out there, and I know agents who do this, I've come across it, I've had it hit my listings, and I've had agents call me up and say, George, I put in an offer on your property, but I just wanted to let you know we have offers out with 3 others. Well, okay, forget it. You just told me the reasons why we shouldn't consider your offer, because we don't know that you're going to actually can go forward, because the intent to purchase is there. But here's the thing. Buyers have up to 72 hours to retract the offer before there's any sort of penalty, like losing a deposit. So you have, I'm trying to remember where the language is in it, but attorneys. So if you have a buyer represented attorney submission, an attorney has the right to cancel a contract within, I think it's either the first 48 or 72 hours on attorney privilege, because they can look at it and go, this is a crap contract. I'm canceling the whole contract. It's done and out the door. So there is an initial period of time when people can cancel contracts without any real penalty, because deposits haven't been handed over. Deposits are required to be handed over within the first 2 to 3 days. It's supposed to be 48 hours, but a lot of times you have, if a buyer's out of state, you have to get the check from them. You have to get it over to them. If they're sending it by, overnight mail, there's delays in the mail service. So it's supposed to be 48 hours, but there are times when I've seen checks come across at 3 and 4 days out. But again, the whole thing about putting in multiple offers at the same time, not a smart idea, because then you get in the position where, as an agent, and we all know each other, I shouldn't say we all know each other, but you start to, if you work in a market, the other agents in that market, and they go, oh, it's George. He usually submits offers for like 3 or 4 at a time because he's canceled on me twice now. And that's a terrible relationship to have. Yeah. So I don't ever coach a buyer to put in multiple offers at the same time. Again, we'll write up the offers and we'll have them stacked and ready to go, because you have to move quickly where it's a seller's market. And we just had this example last week, actually, where we wrote up offers for one person in particular. We had them stacked and ready to go. We submitted the first one that they really wanted. We did that one first because we also knew that there was a call for offers on that one. I called the listing agent, talked to them, found out where we stood. They came back and told me flatly, they said, you're in the running. Okay, so hang on. We're going to hold this other offer aside for a second here. And because in the running simply means that we have a competitive offer. We're within the price range. We're within the contract terms. So we're in that running. They can't tell me yes or no to it. That's the seller's decision. But then they ended up not getting it because somebody came in after us with a better offer. So now, okay, that one's canceled. So I've got the notice from that agent. We're not in the consideration. Now we drop the other offer. Let's go through the same thing. Where you have to be careful is that you start submitting too many offers too quickly at the same time, and then you get tripped up, because what if one of your offers, what if your buyer gets accepted on more than one property? It's unlikely to happen, but it is always a chance. And so we don't recommend it by any stretch.
Well, and that's the thing, though, is I hear all that and I say, yeah, that is good faith on the buyer's standpoint. But think about a buyer who submitted an offer, sees 3 other homes, and they like those homes, but they're waiting to hear back from the first. And then the seller says, oh, you know what? I'm going to give it another week. You know what? I want to give it another week and a half. I almost feel like that's what I feel like the good faith scales are tipping a little bit in the seller's market towards the seller's favor.
Yeah, but if that's what's happening, so if the buyers put in that offer and 48 hours has passed and the agent are getting communication back from the listing side saying, hey, I think it's going to go longer out. It's in the buyer side interest then to say to the listing side, okay, you have our offer in hand, but we need an answer by this date because we need to be able to move on other offers. That's a risky statement because then the listing side is going to say, well, I've got 6 other offers, so what am I risking if I lose yours?
Yeah.
But there again, I gave that example where it took 2 weeks. There are extremes like that. On average, it's going to be 2 to 4 days for an answer to come back. And in a market where it's to the seller's advantage, technically speaking, every market's to the seller's advantage. Okay. Any house that is properly priced is in a seller's market. The houses that sit are because they're improperly priced. It doesn't matter how active a market is. If there's more buyers than there are sellers, a house that is properly priced will always sell.
Yeah. Yeah, I would agree with that.
So, okay, I'm going to turn the table on you for a second.
Oh boy. All right.
Yeah.
Go for it.
All right. So just as you've had questions, I've had questions come up from buyers. And the biggest one, and this is a longer conversation, I know, but if you can at least give a minute of time on it. Buyers are really confused by what it is that drives mortgage rates. Okay. Oof. So the whole thing, yeah, I know.
Yeah.
It is a longer answer, but
yeah,
it is coming up because, so for example, I can't use her name. A buyer I was talking to yesterday, we were talking about things and she made the comment. She goes, I'm going to talk to Bill. And I said, okay, that's good. And she goes, and I'm going to talk to somebody else. I said, okay, that's good. She said, I'm going to talk to somebody else. I said, okay, that's good. I said, so you're going to talk to 3 different lenders? I said, fine. What's the question mark for me? And she said, well, why am I getting different rates from all of them?
So rates at the end of the day are driven by investors. That is the most important thing to understand.
Right.
Investors that are trying to get a return on their investment that beats some things in the market that they could get a return on. They want it to be safe. Mortgages are considered safe investments because typically people pay their long-term, their 30 years. Typically people pay their mortgages because they're living in the property. So, there are treasury bonds, which, this goes into the whole Federal Reserve, which are typically considered the safest investment. You don't get a huge return on that, but they're considered one of the safest investments. And mortgage securities, which is what all mortgages bundled together become, are right around there. They're considered a very safe investment, and the return that the investors are going to get on them are kind of what sets the rate. So when inflation is going up, which is really one of the bigger drivers right now of rates, when inflation is going up, you have to get a better return on your investment just to beat inflation, right? So if your dollar today is worth less in the future, then they're saying, well, I need to get more of a return then in the future to outweigh some of this additional risk that I'm taking on. So if inflation is 7%, rates should be 5 or 6%. They should be close. They're not going to be always exactly at inflation, but close.
Okay, so that's an important way of looking at it. So even though inflation can be 7%, okay, which is what we hear in the media, hey, inflation has now hit a 40-year high, et cetera. Mortgage rates are going to trail the inflation. It's not going to match or exceed inflation. It's going to trail the inflation. But one of the things that people don't understand is why at the finite level. So I talked to mortgage company A, and they gave me a rate of 5.625. I talked to mortgage company B, and they gave me a rate of 5.375. I talked to mortgage company C, and they gave me a rate of 5.455, whatever. So that there's these minor nuance differences in there. And, somebody said to me, like, George, I don't understand why it's different. Because if I go onto Google and I type in mortgage rates today, it's going to give me today's rate. And of course, today's rate is based upon best possible outcome, how much money you're putting for a down payment, et cetera. But the nuances of it, those small incremental differences between different, they look at traditional lenders like a large institutional bank, and then they see somebody who's just a broker there's literally a guy down in Florida. I've told you about him. So he just sits on his couch and he's just fishing around finding investors to buy the loans, right?
Yeah.
And then you have organizations like yours, which are direct lenders, stuff like that. Okay.
Yep. So that is the wide array of program, investor, day, all those come into it. So a 5.6 versus a 5.375 versus a 4.875, maybe you're looking at a standard conventional loan. Okay. And the person that you're talking to is planning for a standard conventional loan, 5.5. Maybe somebody else says, oh, well, you know what? I might be able to get you into the first-time home buyer program with a conventional loan, Fannie Mae's Home Possible, Freddie Mac's. Fannie Mae's Home Ready, Freddie Mac is Home Possible. Those have some lower interest rates sometimes in certain scenarios. That might be maybe a 5.25. Oh, no, you know what? I actually might get you within CHFA's income limits, a conventional loan.
Connecticut.
Yes, specific to Connecticut, but they're a conventional loan in a state agency box. They set their rate at 4.875 right now. Actually, I think it actually went up over the last 2 days to 5%. Now, that can be a range of programs and products, and then also just investors. So we might have, I see this sometimes day to day, you might have an investor come in and price. They're looking for a set amount of loans. Maybe they're like, listen, I have to deliver 500 loans at a 5.25% interest rate, conventional loans, 700 credit scores. I have to deliver those. I've made a promise for a certain security. They're going to come in. And if you happen to be pricing that loan when that investor is saying, yep, open for business, come, I want to buy some loans, you can grab that deal. Once that investor fulfills their quota, they might be out of the market. I might not have the investor that somebody else, has for a specific loan. They might beat me conventional, and then you come to me and I say, well, let's try FHA, and I crush their FHA because that's the investor that I have at that moment.
Right.
So, while we're all usually pretty close, if you see someone at 6.5, something's funky there. That's a specific program that they're taking you through. If you see somebody at 4.5 today, you're paying points, or that is, again, a specific program that somebody's doing. When you go to like a local bank, they can actually sometimes hold the loan, not sell it to an investor.
Right. And
they'll set a different rate for themselves, not always below market, but sometimes below market. If they're looking to, hey, we have $1 billion sitting on the sidelines. We want to put it to work. Let's get some loans in. Let's get some mortgages going. Let's offer a low rate to get people in. There's so many factors that go into it. It's really, it's tough because, it's hard to explain day to day what goes into each rate that we see. Because again, during the day, sometimes it changes when an investor comes in and out.
So I think if I were going to summarize it, because I'm thinking as you went through that, which is incredibly helpful, because I'm thinking to myself, how do I want to summarize this to a buyer who's just learning about even buying a house? They're feeling overwhelmed by the fact that they got to find a house, make an offer on a house, feel like they're quote unquote winning the bid, being able to afford the house, figuring out what they're going to pay in utilities, understanding about insurance, blah, blah, but they got all these things on their plate to figure out. Trying to explain to them, well, here's the nuances of the rate. And so if you go here, it might be this, that just gets, that's going to drive somebody batshit. I already swore, batshit crazy. So
absolutely.
The thing is, though, the nuances that you just described, what comes up in those nuances, they are as specific to a day as they are to a given period of time, as they are to the organization doing it. So it's not really fair to tell a buyer when you're comparing lenders to look strictly at rate as a comparison, because it's going to come into the services provided, it's going to come into fees that are being attached to it. It's going to, the loan origination points and fees and stuff like that. You made a good point about buying down the points, so
Yep.
that may be a way to lower the interest rate. It could be that somebody's coming in with a loan type that doesn't require a PMI. That's going to obviously change the monthly, but it may not affect the rate. So all those things go together. And that's when because most buyers, this, Bill, most buyers walk in and they go, all right, I can afford X dollar per month. That's the way I'm going to build my loan. As long as I'm not above that number, I'm good.
Yep. Yeah. And some loan companies, I'd like to believe that I don't do this, but some loan companies are like a car dealership. When you go to buy a car, they're not talking about interest rate. They're saying, what's the monthly that you can afford? Okay, I'll make it work. And so there are a couple companies that are famous for charging points. I've gotten a couple from some online lenders that, have this great rate available, and it's a pretty good rate. It's usually around market, maybe a little bit below, but they usually charge 2 points to get that rate, which is a point is 1% of the loan amount. So your closing costs might be $6,000, $7,000 higher, but okay, well, I got this great rate. So yeah, there's a lot that goes into it. And honestly, right now with the way rates are moving, which is up, I can't describe it any other way. What you should be focusing on, in my opinion, is keeping costs low, because there's almost certainly going to be a refinance opportunity in the future to get into a better rate. When a lot of this craziness is going to die down and settle out.
But and we could go on the soapbox, you and I. We could talk on this topic for hours. But the one thing though is that even though rates are higher today than they were a year or 2 years ago, they're not excessive. I mean, it's perspective.
Yep.
Because at the end of the day, we've talked about this before. When I bought this house, I had two different loans. I had a principal, a primary, and a secondary, and I was paying 11 and 15% on those loans. Right? Somebody today is sitting there going, "Oh my God, I'm paying 5 1/8," and I'm kind of going, "Yeah, I remember the first time I refinanced and I was at 6%.
Yeah,
I was thrilled.
That was great. Yeah.
So I think everything is perspective, but unfortunately, buyers are being coached to number one. I hate to say it, but they're being coached by marketing that's out there to quote unquote win the bid.
Yep.
Go all in. I actually had one buyer that you and I spoke about. They did not come your way, but they did leave the lender they were first starting with. They ended up going VA with another group. But when they first came in, the lender who was working with them at the time said, just go out there and make big offers and don't worry, we'll back you. And when he told me that, I was like, you got to be kidding me. They actually made that statement. And he sent me the contact, and I called them and I said, so what's his pre-approval look like? And they said, no, don't worry about it. Just go out there and put out offers. We'll cover it. It's like, that's a deadly recipe. So
it is.
Buyers are coached more and more to just write offers quickly and at high numbers to quote unquote win the bid. And you made the comment earlier, this is when you're making a purchase for $300,000, you shouldn't be just rushing at this. It should be something that's a thoughtful, diligent process. Of course, keep costs low, et cetera, and so forth, all of that. Anyway, there was one other question I wanted to ask you. Comes not staying on rates for a second. And you've talked about the CHFA. So here in Connecticut, we have the Connecticut Housing Finance Authority. That's CHFA, right?
Mm-hmm.
They offer loan products. And then you have your own in-house loan products that you guys offer and all of that. So a buyer asked me the other day, because we were generalizing things under FHA and conventional. And they said, George, the loan that I was given by my lender is called this. And they thought it was a different type of loan. And I said, no, is it fundamentally, at the end of the day, it's either going to be conventional in its terminology, or it's going to be FHA in its terminology, or it's going to be VA in its terminology. But is there something else that you would classify it, or does it really just fall into those three types?
Yeah, I mean, listen, the three that you mentioned make up the vast majority of loans that.
So aside from like a USDA loan, for example.
Yeah, so there's non-QM loans. Right. Which are separate. And then there's also, as I mentioned before, with small banks usually are the ones that end up doing things like this. they can create their own products that they end up holding, because they're not, if the investor, so we write, because the loans that we write go to investors. Investors tend to buy FHA, conventional, the big ones, because they know what they're getting. There are some banks, there are some credit unions that are a little bit larger, and they can create their own products. Now, they will usually fall within kind of typical FHA, conventional, or VA guidelines. So a lot of that will be the same. But as far as, like a boutique product, they are out there, and they're at those kind of community banks, probably less likely like at a Bank of America or a Wells Fargo or something, probably less likely there, but like a Naugatuck Savings Bank, I see American Federal Credit Union. Those types of places might have some unique products that fill a very specific niche. Not always better products. Some of them that I've reviewed, I wouldn't consider a better product, because remember, there is still an investor at the end of it. It's just the investor is the bank. They're looking for a return on their investment. If something seems too good to be true, it still probably is. Somebody's making money off of it somewhere.
Right.
But there are still products out there that, me as a direct lender, using our money, we don't hold the loan. So there are some products that, local banks have that fill a very specific niche.
That's helpful, because one of the things that I keep running into are, we ask people, when we're going and we're starting our offer process, one of the things that we always ask is, what's the loan type that we're going with? And generally speaking, it's, I'm going FHA, VA, or conventional. Right.
Yep.
Okay.
Yep. Those are the three big ones.
Hey, listen, so I got to run, but I got to follow up with you, because we have that he wants to know what we're doing with the offer. So we got to get that.
Yeah. I saw some messages coming through.
So we'll get that done, and then there's some other things to catch up on in general. But listen, I appreciate it. I appreciate the questions at the beginning. I hope I answered them well enough for you.
Absolutely.
And I think in terms of rates and everything else, we're going to probably be talking about that some more. One thing I will tell you, we have people that you and I have worked with over the past couple of years now, who are actually starting to reach out to me regarding refis, and because they're wondering, when's that time going to come? Not right now. They're not thinking right now, but they're asking that question of, so when do I start thinking about that? And we'll cover that some other time, because I don't know that there's really a set period so much as it is okay, I know you have a minimum period for when the loan is originated, but beyond that, there really isn't a set period to say, you don't have to wait. You close the loan and it's been a year, refinance the damn thing if the rates are there.
Yep, that would be a great other video to we can go into a couple different angles on that one. So that is a great topic to cover.
Okay, cool. Hey, listen, I'm going to run. I'm going to put this together. I'll get it over to you as well, and I'll catch up with you on the flip side.
Beautiful. Sounds like a plan. Take care, George.
Hey, be good. I'll see you. I got to figure out how to turn this thing off again now.